Good morning and welcome to the Killik podcast for Friday the 8th of January. Welcome back. We've been greeted with two trading halts in the Shanghai exchange and the worst four-day performance in the S&P in history. Down over 4.5% in the first four trading days of this week. Futures are pointing to a higher open and we've got a higher FTSE this morning. But this has been in response to China, the Chinese market and the Chinese currency. We've had a relaxation of the peg of the RMB against the dollar over the first 4 days of this trading week, which has allowed that currency to drift quite significantly, as we can see here, against the dollar. It's not only the Chinese currency, but we're also seeing major strength in the US dollar against the Mexican peso and the Canadian dollar, their other major export partners. So we've seen considerable financial tightening in the US, which is affecting that GDP estimate, which has been brought down quite considerably over the last couple of weeks. So as a result, we're faced with this conditions where people have a lot of anxiety over the ability of the Chinese government to control their economy and the slowing of growth that we're seeing there. And the possibility of them exporting fairly major deflation to the rest of the world. So within the US economy, which is the primary market that we're worried about because it leads through to the UK market in quite a significant fashion, we've got falling growth, we've got tightening market financial conditions, and we've got a Federal Reserve that wants to raise rates. Clearly that is a difficult position for equity markets, and that's why we're seeing so much follow through from the Chinese economy and their market into developed markets, particularly the States. So this week we had also, in addition to the Chinese information, we had the Fed minutes. They were actually more dovish than previously anticipated, suggesting that the move to raise rates, which was the preoccupation ahead of the end of the year, was a very balanced call. As a result, we've seen a significant fall in the probability of another rate rise in March. So what we're seeing at the moment is a real tug of war between a domestic economy in the US, and we're going to get more information about the domestic economy this afternoon with the non-farm payrolls, which looks to be on track, looks to be growing strongly. We're expecting 200,000 new jobs in the States over the last month, which would suggest that you need higher rates because we're starting to see wage inflation coming through. And that's been marked against a very poor international picture and a major economy that's having major issues and looking for different mechanisms in order to resolve those issues. So these conflicting macroeconomic environments are being played out in the US market and making it very difficult for policymakers and therefore creating increased uncertainty. So today, or actually last night, the Chinese central bank stepped in to stabilize their markets. So they took away the trip mechanism that halts the market if the market falls 5% and then 2% on reopening. They've also revisited some of the restrictions on short selling. And we go into this weekend with some more very important macro data for China, which will be closely scrutinized. So we've got the CPI and the PPI numbers for December this weekend. So just focusing on the PPI a little bit, this is the producer price index. This is the price that producers are getting for their goods. And we look at it as a proxy for Chinese profitability and corporate-wise. We're seeing a sustained wage inflation picture, so any falls in the PPI is compressing Chinese corporate profitability. And as we can see here, this has been falling for quite a long time. And the last print was minus 5.6. And we're very sensitive, or the market's very sensitive to another poor print this weekend, because what is happening is that it's not responding to the money supply and the liquidity injections that the Chinese government or the Chinese central bank are inputting into the economy. And that's leading them more pressure for them to devalue their currency. So we think this is going to be an ongoing issue for markets, but we need to balance it against the strong domestic economic data that's coming out of the US. So we had a precursor to this sort of market back in August when we got a clear sense of what will bounce first in this type of scenario, and it's led economy portfolios to be positioned for stocks that are not exporting disproportionately to China or producing commoditized goods that will suffer from increased competitive substitution. It will also, in this lower GDP growth scenario, sustain high growth structural stories that can continue to grow in these sort of conditions. The currency wars that we're seeing at the moment, this sort of race to the bottom that we talked about previously, will maintain QE in areas like Europe, which will maintain very low interest rates. So that benefits the domestically focused, rate-sensitive stocks within those economies. We also expect to see this ongoing pressure in commodity prices. And again, there's a net benefit to consumer stocks and businesses where energy is a high input cost. So this blanket leg down in markets across the board continues to give opportunities to substitute into those areas that we think will bounce more quickly when we see some stabilization coming through. So the week ahead, the US economy, in terms of their results season, kicks off as usual with Alcoa on Monday, and then we see the big US banks reporting, and they'll have the most influence on the market next week. So we've got JP Morgan on Thursday, and we've got Wells Fargo on Friday. Our view of the financial market is that currently stocks are pricing in a one and done, one interest rate rise this year and done, and some asset deterioration in the current valuations of banks. Given that sort of particularly base, slightly bearish forecast, we think there is room for multiple expansion if that doesn't pan out to be the case and we get more interest rate rises in the States. We also think that payouts will increase across all of these stocks because their balance sheets are very well capitalized and regulators are starting to allow them to release more capital to shareholders, which should drive a re-rating. We also think there'll be a beneficiary of higher consumer spending, and asset quality generally outside of the energy sector is good. So we favour those banks, and we'll be looking to the results season as a trigger to continue to add to that sector. So that's it from me. Thanks very much.